It's not pouring, I mean, it's raining dollars. 40,000 crore approximately is what you've seen in last 3 months. There is so much of liquidity that bulls cannot put a foot wrong. I thought markets always followed earnings, macro, and the long-term economic outlook. Why are foreign investors blinded to what's happening in the real economy?
See, good morning. 2 reasons. One, of course, I'm really angry that you made me feel literally very bad after quoting the Ambani figure of the wealth. Suddenly, I find myself very, very poor and not happy about it. All right. So that's not good news for my personal net worth, right?
Maybe
it's so puny that I can't even compute in the decimals.
Ajay, the reason why I quoted the money figure is because I don't know your wealth figure. If you're happy to share, I'll be happy to comment on it.
I believe me, it'll be in some decimal which will run across the page, okay, compared to that net worth. So let's leave it. So that is what it is. Anyway, that's the lighter side. But I think it's important to understand that we in economic textbooks never had a concept called negative interest rate. There's no textbook in the world even today which has a concept called negative interest rates, that I give you money and I can take back less money after 1 year. That's unheard of economic concept. When you unleash that kind of stuff on the global economy, you're bound to have people taking risk of all kinds and shapes. It doesn't matter anymore, because even if you do nothing but keep getting some dividends, even if you do nothing but get 1% or 2% return, you are good enough on that basis. We have seen this play out number of times. It's not the first time liquidity rally has played out. Unfortunately, India is different than the US, and your right question is this thing, because compared to the US, where the economy is also doing extremely well, we are from grounds up doing pretty badly. But the caveat is that grounds up could be doing very badly, but the top tier companies have got a big largesse in terms of tax. If you look at the finance minister's speech yesterday, there's a reference to distribution tax, dividend distribution tax. So that budget might take off the distribution tax. So the listed corporate, large corporates definitely are benefiting from the economic policy, and to that extent the FIs are coming in there. Now rest of India wants to party with everybody else, that's a different matter. But the key is economic policies of the government and global flows are now matching together and taking the index up, and that's what is really happening. And you write it because the government is with you at this point of time, not on liquidity. The government is with you at this point of time.
Okay, so Ajay, let's try and map it and trek it to the top. Let's try and get all of our viewers, as well as Nikunj and you and all of us, a little closer to Mr. Ambani's wealth. What stocks could you bet on, which will make you richer in, say, another year, 2 years from now?
See, I am a firm believer of the trodden path. I don't really go into venturing into jungles and get lost. Last time we tried it 3 years back, and believe me, we just managed to get out of the jungle alive, which is the small and the mid caps. So I would still say the trodden path is where the government economic policy is, which is very clearly saying is that large corporates banking large private banks will continue to benefit. There's no doubt about it. We have a big power debt overhang on the nationalized banks, so they may give you a little bit of fill up, but eventually the chickens will come home to roost, because power dues are going to come into a big problem in the next 6 to 9 months. So nationalized banks is going to be an issue, and whatever the consumer loan, mudra loans, all this will be written off again. So nationalized bank, unless they are privatized, and if that is your case, you can buy it. But I would say just stick and follow closely the path of the private banks. They are doing fine. They have a monopoly. If you want to ask me 2 sectors which you spoke about last time, which have really underperformed, one you alluded to in just conversation was the pharma sector. I think it's ready for a big jump in my view, because they sorted out a lot of US issues, domestic industry is doing well, no sign of price controls, and corporate tax rate is going to give them some benefit. Dividend distribution growth, that's going to be a big benefit. So I think pharma, and the last one would be metals. I think that is one which is slated for another big bump in my view, because if the economy stabilizes and we return back to some kind of a semblance of growth, they are the first point where the demand has to come in. So I would say take the metal, take the pharma, and take the private banking space. I think you are just doing fine with your portfolio at this point of time.
Okay, I'll come to pharmaceuticals and metals in just a bit, Ajay, but how much more of the private banking names would you buy? I mean, would you really touch a Yes Bank on an RBL right now, and how much more of ICICI Bank and HDFC Bank would you hold in your portfolio?
See, that's why I said you have to, okay, 2 points. One is, whenever you're buying at a peak, historically, you don't buy returns at the peak, you buy risk at the peak. So when you are investing big time at this time, you are investing more risk than return because the liquidity full rally, nothing to do with fundamentals. So you may come to haunt you for a long time. Except the benefit is that even if there is a steep correction in the market or whatever, global liquidity starts to ebb out, or we have a high inflation in India, all those put together, you would find that there will be the last point standing in terms of these 4 or 5 institutions. So if you were to be in this market, you got to be there because they have literally, it's like a telecom. 4 banks have a monopoly on the private sector space in India, which is unprecedented in global industry at this point of time. So I would say you can keep buying safer, but we are buying risk at the end of the day. You might have to wait out the return longer, but let's not worry about whether there'll be enough buyers in the stock, because those have been tested now last 5 years, 7 years. We have tested HDFC Bank, and of course there's a leadership change which might change a lot of views about the bank, but so far on the fundamentals, if you're stuck to these banks, you've done a phenomenal return. You've stuck to Nestle's of the world, Livers of the world, you've done phenomenal returns. So I would say large cap, surplus, just don't worry about it. Don't add too much. As I said, it's a risk right now. But don't worry also too much because there's a long way to go with these stocks.
Point which I sort of have been debating and also trying to wrap my head around it is that if one works with the assumption that recovery will happen, whether it is end of this year or next year, recovery will happen. Your base has come down to a sub 5% GDP growth. Where do you think the delta of recovery will be higher? Will it be in consumption, autos, discretionary and durables? Or will it be in cyclicals, metals, cement, or for that matter, industrials? Because recovery will happen, Ajay. We both know that. That's how markets move. That's India for you. It's not going to get into a recession. We could swing around, we can get tossed around, but next year definitely because of base effect will be better. So the question is that which end of the market do you bet on? Consumption, industrial, cyclicals?
Okay, the 2 things you're kind of assuming, and I think that's one of the fundamental assumptions which is getting tested, that there is a direct connection between the state of the economy and the state of the capital markets. And I think that's an assumption we have to give by, because the state of the economy is nowhere in comparison to what state of the market is. And that is what I said, that you need to just dealing those 2 issues. There will be large parts of India which will suffer, and is already suffering, will suffer quite badly in terms of the economic progress and in terms of the growth, employment, etc. That will be a large part of India. But there will be a part of India which will benefit from the government policies, and that is why I said we need to divorce our sentimental thinking from low GDP numbers to the fact that the top 200 companies in the country are having a much better time with lack of competition and all other governance issues and all economies put together than perhaps ever in the history. So I would say caution you again saying linking the economic growth to the market, and I'll give you an example of that. The more the smaller shoemakers disappear, the more the Bata gain. The more the smaller condiments makers disappear, the more the Nestle gains. So it's and number 2, the more if you give her the cut in the tax rate, it's who's gained. The top 200 companies gained. The smaller guy never paid the tax because he was anyway losing money, so it didn't matter to him. So I would say fundamentally that you need to divorce yourself from the economic aspect to the capital market. I think they're too far apart at this point of time, and they may be playing out in political compulsions and the results in state assembly election, etc. You can see that, but that's an honest fact. We may not like it, but that's what it is. Number 2, when the market turns around, as I said today, in terms of pure market, we believe metals will be the outperformers at any point of time, because given where they are today, and most of them are, I think, kind of debt-free at this point of time, but at the low end of the earnings cycle, very low prices, price to book in sub 1s, I think you just cannot go wrong in terms of doubling or trebling. At least you'll go to 1.5 times book value for a decent metal stock, or 2 times book value. So I think metal would be the first stage where you'll get alpha returns, in my view. You'll get returns all sectors, but metal would give you perhaps the best alpha returns as the economy turns around.
Buy a pure India play like a SAIL? Do you buy a global interplay like Vedanta? Do you buy a Europe plus India interplay like Tata Steel? No, I'm saying that metal is it's a large sector, and in India there are a variety of metal companies. iron, ferrous and non-ferrous. Within ferrous, you've got local players, global players. Within non-ferrous, you've got local players and global players. What would you bet on?
See, two places we have bet on. We are already placing our bets on. One is the non-ferrous, which is primarily based on, there are only 2 or 3 companies, so you really don't have too much choices in the non-ferrous. And you know it, you have a Nalco, you have literally you have a Vedanta, and that's all about you have in terms of non-ferrous. And we have holdings in both just for disclosure purposes at this point of time. So non-ferrous is 2, but I think steel could be a stunner because now steel is in a very strong hand. All the players are in a very strong hand. No need to discount in the market. The debt overhang is gone by and large from the sector. It should get some amount of government largesse in terms of orders or some concessions and so on and so forth. So I think you would see that non-ferrous and steel in that order would be the better place to be, and as a pure India story. I do not bet global stories because if I have to bet global stories, I would go abroad and bet. I'm not betting metal overseas. I am betting local India at this point of time because if any revival takes place, you need more aluminum windows, you need more steel, you need more iron railway tracks, you need all the kind of stuff. Without that, it's not going to work for the India story. So I would say non-ferrous first, steel second, and local domestic at this point of time.
Order when it comes to metals, but given the fact that we're seeing that the valuation discount of mid-caps is close to 10-year highs, do you think that as of now that presents a fairly compelling opportunity? What within the mid-caps? I know you've spoken of a lot of sectors, but you know the kind of businesses that you would look at within the mid-caps.
There, I think you touched a raw nerve on mid-cap in most market players at this point of time. But I will take a hazard this one at this point of time. I think mid-cap you need to focus on, in our view, if you really want to be there, you got to focus on high dividend paying companies because those are the companies which have got steady businesses, low debt, and ability to pay big amounts of money back to the shareholders. In fact, in some of the cases, the returns are 7, 8, even 10% dividend rate of returns. So instead of looking at an industry pack, I think you need to look at the dividend pack of midcap and say, if he can pay 5, 7, 8% dividend consistently on strong cash flows, and we all know there is no capex need by any company in the next year or 2 years, so unlikely for him to be putting money for capex for 2 years' time. That is a segment you draw down and say, this is where we want to be. And this has been not a bad segment where people have been able to give good dividends and kept your return okay. So I would say don't look at industry, look at dividend paying as a criteria for mid caps because that will qualify all the decent companies in the bucket and you can then pick and choose. So instead of industry, I would say dividend paying is the yardstick that I would use to evaluate mid caps.
Because mid cap and dividend normally does not come together.
Oh yes, you're right, Nikunj, but this is a peculiar situation where you find so many mid-caps giving dividend yields of 8 to 10% even at this point of time. So that's why I said it's one of the peculiar time of the life where mid-caps are not borrowing, they are not doing capex. And when we say mid-cap, okay, definition is maybe 500 crore, 1000 crore company, we call it mid-cap because SEBI definition is mid-cap. But you will find that they are giving very attractive dividends at this point of time. The share prices have fallen dramatically, but the cash flows are very, very good at this point of time and mostly have deleveraged or in the process of deleveraging. So it's a very peculiar phenomenon we're seeing in capital market, mid-cap and dividend, which we never saw before.
I am looking at my screen. I can't find companies which are giving 8% dividend yield, market cap criteria less than 1000 crore. Maybe you have some different data. Why don't you educate us?
We shall send it to you, the program that we have got mid-caps which are giving us yield of between 5 to 10%. Definitely we have got at least 8 to 10 of them in our portfolio at this point of time.
We shall talk about it. Good luck, always fantastic to have you back, Ajay.
You know, 5 and 7 are abundant, Nikunj. 5 and 7 are abundant. I can tell you one of the cuff itself. If you look at HEG, 50 rupee dividend, 1000 rupees share price was 950 rupees share price not long back, if I'm not wrong.
The previous cycle with HEG, I mean, HEG must have given this dividend when they were in a bull run because there were a shortage of electric graphite electrodes. That's last year. You know, it's like buying a commodity cycle. When the year was great, the dividend was strong. Maybe that dividend could not come.
It has come this year. See, that's why I said what these companies have done Earlier, they were leveraged. So when they were getting into a cycle, they were over-investing even at the peak of the cycle. Now what's happened, Nikunj, in the mid-cap story is that they have enjoyed the peak of the cycle. They have deleveraged themselves, not invested too much capex in the market, and therefore are able to come out smiling at the end of the day. That's why I said there is now a qualitative difference in the top 200 mid-caps who have not invested at the peak of the cycle, but use the cash flows to deleverage themselves and clean the books of the company. You know, if you take REC for instance, look at the dividend of REC. I would call it a mid-cap only. I think it's upwards of 10% if I'm not wrong in the dividend straight. Now, portfolio may go wrong in the next 2 years or so. I can't say that. But dividend has been extremely strong in REC for instance. I'm not sure what the number is. If you have the screen, you can look at it. But I think it was upwards of 8 to 10%.
Thanks very much, Ajay, for joining in as always.